to send my thanks to Trusted Insight. They've been our host for this inaugural event, as well as they've been great partners for the W.K. Kellogg Foundation. And it's a privilege for me to share some guiding principles that we have used in managing our assets to support the mission for the long term. All of us with this privilege of managing assets really intended to advance social good and create change are really in a legacy business. We are stewards of legacies of founders, ensuring that money meets mission into perpetuity, and the vision and the intent of the donor can be achieved. Our founder, in this case Will Keith Kellogg, offered a simple, profound prescription to guide the essential work of the foundation. Use this money as you please, so long as it promotes the health, happiness, and well-being of children. The Kellogg Foundation is committed to ensuring that children, families, and communities, regardless of race, origin, or income, really have the opportunities to achieve their full potential. Embedded within all that we do is our commitment to racial equity, to develop leaders, and to engage communities into solving their own problems. This is part of the core values of the Kellogg Foundation. So the greatest contribution that we, the investment team of the Kellogg Foundation, can make is to equip the programming staff with the financial resources and the confidence in continuing growth of those assets that they need to continue that work. As those of you in the foundation side know, investing this fund for the perpetuity is not easy. There are no more incoming assets. To be successful with these dollars, we must earn a 5% real return on our investments to make payout and to maintain purchasing power of those assets. The Kellogg Foundation's trust have an endowment of about $8.5 billion, made up of $5 billion in Kellogg stock, and then $3.5 billion of diversified portfolio. So for we, the investors, it's a big deal, and it's not easy. So how do we achieve this 8 to 10% long-term return that can contribute to our mission? We need to have a solid investing philosophy for the diversified assets that we believe in wholeheartedly. We have adopted our version of the value investment philosophy, which is driven by cash flows. The foundation of this philosophy is a cash flow and value basis that runs across every position in our portfolio. Cash doesn't lie. This gives us the best downside protection in tough environments, and it's the only real measure of success. We measure cash flow through a bond-like duration measure. Investments have high current cash flow or shorter duration with a specific return expectation, while investments with future cash duration, such as VC, we look at longer duration assets. In those cases, we're seeking to generate higher returns. Basically, the Kellogg value philosophy breaks down into several key factors. I like to say, simply put, we look to make allocations in assets that are going up. Simple enough. Getting a little bit more specific, we look for inefficiencies in markets. We look for forced sellers, and we look for lack of buyers. We love complexity. Things that other investors don't fully understand or don't really research. Investments with a scarcity of capital. Assets that are unreasonably priced and undervalued, and distressed or defaulted situations. We love those type of environments for generating good risk-adjusted returns. Our manager's analysis across the board are bottoms up. Security by security, and while we, of course, follow the economy, we don't rely on macroeconomic forecasts for our returns. We found that these results in assets that can be far outside our benchmark offer great downside protection and lower volatility. We outperform by doing well in declining markets and simply by just keeping up in strong markets. Over the last couple of years, we utilize an internal risk budgeting system. It's something that we found is helpful in markets that we're more skeptical of by keeping us in the market and also forces us to make those tough decisions during declining markets by putting more risk to work. The key to getting this strategy right is in keeping the foundation's board of trustees educated on philosophy. It was mentioned earlier, the governance structure. They understand our way of risk-taking in the portfolio. They understand that our returns will not look like the benchmark during specific periods of time. The other piece, the stability of the team, is also crucial for the continued success. The team can patiently await and is ready to chase those fat pitches that have come across the globe. In addition, the team has carefully laid out a list of what we called our non-negotiables, of requirements that any public, private, or hedge fund must possess. If in researching a new idea, that manager does not pass all of the non-negotiables, the team gets together and discusses the problem, and then either approves to continue on working or puts it to the side and says it's not worth the effort. This process has worked great. It's really one person, one vote, and while it's not perfect, this simple list has helped us avoid problems and keeps us on track. So our legacy as a team is in how the decisions we make today ensure that Mr. Kellogg's money continues to advance the well-being of children tomorrow and for years to come. Let me be clear, this is absolutely the biggest and best mission-driven investment we can make. The Kellogg Foundation was among the very first to put its money into advancing its mission through mission-related investments, something that we call internally mission-driven investments. Anytime we use Mr. Kellogg's funds to advance social good, we want to use the best funding tool to make that happen. These MDI investments are not counted as payout and therefore must come from the investment portfolio. The program is currently targeting $100 million, and we have 27 different investments in the portfolio. And it's a combination of direct investments and also through GP private equity structures. These are truly impact investments. They can include direct investments, fixed income, private equity, and private real estate that harness the power of the capital markets and support the well-being of children. MDIs are made in both not-for-profit and for-profit entities, with the foundation's mission with a potential to render greater financial and social returns than program-related investments, or PRIs. We envision these organizations using these funds to invest in their business and in their future and stand on their own long after the Kellogg Foundation's monies are there. Financial return goals for the MDI are closer to market returns, with expected real returns of anywhere from 3 to 8%. We're one of the pioneers in this field, and our program recently hit its 10-year anniversary. We've had smooth driving for some great returns, both social and financial, and as well as some good-sized potholes in the road. One of our highest profile mission-driven investments that has recently been monetized is one that's around the corner in Oakland, California. It's a company called Revolutionary Foods. Convinced that nutritious and good-tasting school lunches could be a forceful contributor in the school recent movement, a teacher and her business school classmates started the company Revolution Foods. And it evolved into a leader in the national movement to transform schools. They have contracts ranging from outside of the San Francisco area school districts all the way to Washington, D.C. Since 2011, the foundation has invested a total of $6 million, both at the equity level and the mezzanine level. We've received a nice return for those investments made. And those proceeds that have come back to the foundation have been recycled into other mission-driven investments. But in addition to the financial return, we are at the beginning of a deeper and really exciting conversation to understand the impact of our investments. We realize that there are, of course, social investment returns as well as financial. we've developed a thought into a philosophy that there are impacts on the entire ecosystem around an organization like this. And those returns can be so significant that they provide a far greater bang for the buck than a traditional grant would. This ecosystem evolution transcends the traditional thinking about double or triple bottom line, and it really pushes the envelope into measuring impact. For example, when we ask an investment in a company, we'll say, what are the quality of the jobs that are created? How do these jobs benefit the children and the families that work at this organization? How does it affect the employees and the suppliers? Were they able to buy homes with a stable income? Did they get better health care benefits versus perhaps getting a part-time job at a local restaurant? We'll evaluate these and other questions and put numbers around that evaluation. Again, this is the early innings, but it's really an exciting work that the foundation is doing. We want to look at all dimensions of how the investment is really benefiting society, and we're beginning to do that. One key aspect I will add, and the most difficult part of negotiating the MDI investment, is ensuring that we receive appreciation and liquidity benefits similar to our diversified portfolio. I want to be very clear. For the MDI investment to achieve its full potential, we need to demonstrate that we can achieve financial as well as social benefits. These financial benefits include interest, reinvestment, and the ultimate return of our capital. As I said earlier, we are comfortable with a slightly lower return due to the social returns that we plan to generate. But I want to be realistic and understand that if we don't have the financial returns, they're not going to be successful. Finally, I want to highlight one more area and give a plug for what I believe is a powerful indirect link between the work the investment team does and our mission. The Kellogg Foundation has historically been one of the leading voices about and funders in addressing the profound structural inequalities related to race that have held back too many of our citizens. And the foundation is unique in that it seeks to not just promote racial equity, but also racial healing. The key focus in this work has taken shape in the foundation's Truth, Racial Healing, and Transformation Enterprise. TRHT, as we call it, is helping communities embrace racial healing and uproot conscious and unconscious beliefs in this hierarchy of human life. Communities across the country are partnering with the foundation, having honest conversations about racism and structural inequalities that have come as a result. So how can we, as investment allocators, do our part to advance this part of our critical mission? As you know, Wall Street investment community is predominantly white, male, and financially privileged. We ask ourselves, how can we make an impact into sparking financial change? Sparking change in the financial community. So in addition to our MDI investments, we're working to build a diversity within our investment community through emerging managers programs. Our goal on this is to generate market rate returns from new managers starting out. If we do this right, we will provide entrepreneurs of color, women entrepreneurs in the investment industry, the resources they need to build businesses, as well as build a pipeline of future investment managers beyond this program for our diversified assets. Working in partnership with Progress Investments, again, right in San Francisco, around the corner, we're providing support and investment capital for a set of high-potential African-American-owned firms, Latino-owned firms, Asian-American-owned firms, and female-oriented or owned firms. We currently have $120 million managed by these emerging managers. And as with all of our managers, we expect them to beat our indices. We will use this program to identify managers and eventually have them take on larger mandates as they prove themselves out. So far, We're pleased that we've graduated 2 managers, and there's one more that's on the board, on the verge of being graduating towards a higher allocation. In conclusion, as you consider your own sustaining and legacy building work, I challenge you to think outside the box and looking for new ways to connect your money, your capital, to the mission of what you're supporting. At the end of the day, our most significant contribution we make into the W.K. Kellogg's Foundation's mission is to really build a great portfolio. We're pushing the envelope, and we're testing what matters. We know our edge comes from focusing on being patient and taking risks to achieve certain goals. Driving a diversified portfolio, but allocating capital to the most compelling ideas. We do have times when we are willing to make those big bets, but they need to be well-researched and well thought out. Working within a governance structure that facilitates nimbleness. We have the authority and the trust of our leadership to make direct allocations into GPs and also co-investments and direct investments. Striving for consistency, which means we'll have a higher batting average, even though we may have fewer home runs. And finally, making long-term commitments to core managers whose structure and compensation aligns with our best interests. I wish you great success in the contributions you all make in your own organizations. Please know that it's an honor to be a part of this amazing group of legacy investors, and I want to thank you all very much for having me here today. So with that, I can open up for questions for a couple minutes, if there are any questions. Yes.
Thank you. I'm Sherry Santos Waste. I was a little bit interested about in your emerging manager program. I have some familiarity with it, having started one at TIAA-CREF a while back. I was wondering about the scope and the size of and the sectors that you invest in within that program.
Yeah, so within our emerging manager program, you know, we're agnostic to the allocation. That said, we're aware that if it's a lockup of private equity, we need to have more certainty than if it is a long-only strategy or even a hedge fund strategy. So generally, historically speaking, it's been more in the long-only side. We've had a couple of hedge fund strategies, but to date, nothing of significance in private equity.